Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. So the first thing we need to do is open up our brokerage platform. The one that I'm using is Tasty Trade, but feel free to use whatever you like. And of course we're going to be writing or selling these options contracts, so we need to know where we are in the option cycle to begin with. So we just want to open up any underlying, this is silver SLV, and we just want to see a list of expirations. And as you can see, we are now presented with all types of expirations. We've got weeklies, we've got quarterlies, and then we've got monthlies. The monthlies are the ones without any W or Q next to them. And we want to stick with the monthlies. So we've got our first monthly here, October 18th, and that is 4 days away. 4 days is far too close for us. We want to be selling contracts anywhere from 30 to 60 days out in time. So if we go to the next one down, we've got November 15th here. That's 32 days away. It is a little bit on the short side, but if you were to go to the next one down, there would normally be another expiration here. So if we just open up, say, Apple, December 20th, right? So we've got November 15th at 32 days, and we've got December 20th at 67 days. 67 days is a little bit too far out for us. 32 days is probably going to be better, because once you get past 60 days, theta decay is pretty flat, and we don't really get the benefits of theta until sub 60 days. So if we had to pick one, I think the November 15th would be better. However, if you don't absolutely need to put a position on right now, by all means, you could just wait a week or so and then put some positions on. But November 15th, if you want to be efficient with your capital, we'll just go with November 15th, 32 days out in time. So now we know 32 days is the number that we're going for. We can take that information, come over to our watch list, and filter out any underlyings that have earnings over the next 32 days. And we can also filter out anything that has a low liquidity level. The reason for this is we don't want earnings to disrupt our trade. It will increase volatility, it will mess up our deltas, and these things will lead to a negative P&L, or it won't be good for your P&L at the very least. And we want everything to be liquid because we want to be able to get in and out of positions easily, and we also want to be paying tight spreads. We don't want to be paying wide spreads. So now all that's left to do is simply list everything from high IV rank to low IV rank. The reason for this is because we want to be selling or writing contracts when volatility is high, and then we want to let the value of the contracts decay, i.e. we want volatility to come out of the contract, we want theta to decay away the contract, so that the value of the contract is then less over time, and then we can buy it back at a lower price and the spread is our profit, or we can just let it expire worthless and we don't need to buy it back at all. So now we have a list, and we want to stick to things that have an IV rank of over 50. Below 50, anywhere between 30 and 50 can be okay depending on the underlying, but typically over 50 is considered high, below 50 is considered low. And we just go down the list. And as you go down the list, you want to keep in mind what's already in your portfolio. If you are heavy in any one sector, you don't really want to be adding more positions onto that sector. You want to be adding positions that are non-correlated to what's already in your portfolio. And one way you can test for what's going on in your portfolio is using beta. You can use beta weighted deltas. But that's a whole separate video. But just generally speaking, if you have lots of airlines in your portfolio, don't look for more airlines. If you've got loads of food companies, don't look for more food companies. You know, just common sense type stuff. You don't need to worry too much about beta weighting and all that kind of stuff. But that is the proper way, and that is the more advanced way to do it. But generally speaking, just use common sense and you'll be fine. Also, keep in mind the size of the underlying. The larger the underlying, the more buying power is going to be required if you are looking to open a naked position. But even if you're not, it's fine. We're going to show you how to manipulate positions. So we just go down the list, and we got crude oil here. We've got USO here. We already have got a position on MCL, to be fair. So USO would probably give it a miss, although the IV rank is very nice on USO. We've got SLV, XLU. XLU being an ETF with an IV rank of 74.5 is very nice. EWZ did just literally overtake it. We just saw that live. That is also another ETF. ETFs are really nice to trade because they don't really move too erratically. And overall, it will just help smooth out your P&L. But typically, absolute IV will be less on ETFs. So we've got XLU here with an IV rank of 74.5. Its IV is currently at basically 21%. Whereas if we look at EWZ, basically the same IV rank, but its absolute IV is 34.5%. And then with SLV, pretty much the same thing on the IV rank, but the absolute IV is 37%. So you want absolute IV to be nice and high as well as the IV rank, because the higher absolute IV is, the more premium you'll be able to collect on the position, but then also the more volatile that position will be. So you'll need to find where your risk tolerance is. So if you have a look, GDXJ just literally overtook SLV in the flesh with a higher IV rank and an even higher absolute IV. So let's go with GDXJ. Who doesn't like GDXJ? It is pretty easy to get in and out of, which is good. Of course, we're going to be 32 days out in time, and this horizontal orange bar here shows you where price of GDXJ currently is with respect to the strikes, and this vertical orange bar shows you what the expected move of GDXJ is over the next 32 days. And so what we want to do is start making money. So we need to sell something to bring in some cash. So what are we going to sell, and how and where are we going to sell it? So there's two types of contracts. There's calls and there's puts. We're just going to sell one call and one put to keep it really simple. And we want to sell it outside of this expected move because we want to have a high probability of success. So how can we ensure that we are outside of this expected move whilst collecting a healthy credit or premium? The way we can do that is by looking at the delta column, and I personally like to be between 15 and 20 deltas. And if you can see on the call side here, we've got 18 deltas, which is perfect. And if we do the same thing on the put side, there's a 15 and a 20 delta. I think we can be slightly aggressive because we're on an 18 delta on this side. We can be at a 20 delta on the put side. And that puts us perfectly outside of the expected move. On the put side, we can see we are just touching it, but this green bar here shows you our break even. So our break even is going to be, of course, where our contracts are plus the premium that we collect, which is why our break evens are actually slightly wider than our strikes. So if we look at our break evens are outside of the expected move, which is why it's okay to go with a 20 delta on this side. So all of those things put together is going to equal a high probability of success. Well, what is the probability of success? Specifically on this position, we've got a 69% probability of profit. And if you want to not take max profit, but if you want to get out of this position at say 50% of max profit, we've got an 81% chance of that happening at some point over the trade. So these are some very high percentages, some very high probability situation or trade. And let's just mark this on a graph, on a chart, so we can see what this would look like. So we would mark out price levels at 45 and 55. So let's just do that now. 45 and 55. So this is essentially the range that we've created. This bottom price level is our put contract, and the price level above is our call contract. And we basically want GDXJ to stay within this range, and as long as it does that, we will be just fine. So if it stays within this range, what does that mean? It means that our contracts, our call and put contracts, would expire worthless if price of GDXJ is within this range at expiration, which is in 32 days in time. So we would collect $1.21 up front times 100 because there's 100 shares per contract. So that's $121 that we would collect up front. And this is what we would keep if GDXJ expires within this range. Now, if we wanted to take max profit at say 50%, then we would pay $60. We'd collect $120 up front and we'd pay $60 to get out of this position. That's what it means to take profit at 50%. So with that in mind, our broker is going to require 1.8k in buying power to open this position. We'd get just under $5 of daily theta decay, and we'd collect $120 up front. Now, if this position does require a little bit more buying power than what you're comfortable with using, that's not a problem. You can simply just come down to the next strike, say, which is at $60 here, and you can simply just buy this contract. And what this has done is create a $5 wide spread. So your loss is now limited to whatever the spread is between your short and long contract. And we're going to do the same thing on the put side, $5 wide at the 40 strike here. And as you can see, we no longer have an unlimited loss potential, right? Our loss is limited to $5 minus the premium that we would collect up front. And that's how we get to this max loss number here. And because our max loss is defined, our broker is only going to require that much in buying power, $403, as opposed to 1,000, whatever it was, close to 2,000 before. So this is how you can manipulate positions to fit inside your portfolio. And that's essentially it. This is how you find positions. This is how you manipulate positions. Now, there is also one other thing that you need to keep in mind, and that is the size of your positions. So what we've got here is a position sizing template, and the way it works is you simply enter in the size of your portfolio. Let's say if it's $5,000, you could then enter in what the current VIX level is. Let's say if it's 11. Below that, everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio, and you'll be just fine. If you want to get a copy of this, link is in the description. Click on free position sizing template and it will take you to where you need to go. If you want to get involved on the positions that we're placing and you want to make money alongside us, again, link in description. Click on EDS Premium, get yourself signed up, and inside you will have access to all of our portfolios. So you can copy our positions and see our live updates and adjustments. There's also a full course, so no prior knowledge is required. We will teach you everything you need to know. If you do still get stuck, it's a private community, so you can speak with myself and other like-minded individuals. There's a 100% money-back guarantee. So once you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. And right now it's £1 a month. The price will be increasing, but once you're in, the price is locked in for you. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.